Welcome back. As promised, I'm about to play you the video that I previously recorded which outlines some of the exemptions to the new stamp duty rules that are coming into force on April the 1st, 2016. But as a little extra to help you discover the local buy-to-let hotspots, if you scroll down the page within this email, you see that I've included some very, very useful market data. Now, over to me. Let's do a quick example, assuming you are going to be subject to these higher rates. Let's take a purchase price of £250,000. If you complete that purchase before April the 1st, 2016, the stamp duty is going to be £2,500. Anytime after, you're looking at £10,000 in stamp duty. Sorry to be the bearer of bad news again, that isn't actually the only change to stamp duty coming into force this April. Currently, there's a base of £125,000, and if you purchase on or below that amount, there'll be no stamp duty to pay, and that's for everybody: home hunters, buy-to-let investors, for second home purchases, you name it. But only for second homeowners and buy-to-let investors who already own their home, they are going to be subject to paying stamp duty at anything over a base of £40,000. I'll stop going on now and I'll get straight on to the exemptions and the ways that can be manoeuvred around getting over this higher stamp duty rate. Number one. This one's a bit obvious, I'm afraid, and we've pretty much covered it in the last few seconds, but if you were to purchase a property now and it was your second, third, fourth, fifth property, whatever, and you were to complete before April the 1st, 2016, you would be exempt from the new higher rates. Number two, let's say you've exchanged contracts after the 25th of November 2015 and you don't actually complete to on or after the 1st of April 2016, then I'm afraid to say that the higher rates will apply. That being said, if you happen to have exchanged before the 25th of November 2015, irrespective whether you complete before the 1st of April 2016 or after, the higher rates will not apply. Now, that's interesting because you think, why would that ever be the case? But in such transactions like purchase options, often where land is involved, it may even be a new property where you've decided to purchase off plan. Those are examples where a delayed completion, such as that length of time, would be applicable. Number three, let's imagine you own your own home that you live in. You also own a buy-to-let investment property. And now you're going to purchase another property after the 1st of April 2016. Of course, the new higher rates are going to apply. But hold on, if this new property you purchase is in fact going to be a new home, that you actually haven't sold your current home yet, you will still have to pay the higher rate stamp duty, but you're going to have up to 18 months to put in a claim to have that paid back. Number four. It's kind of a follow-on from number three, but I just want to cover this for the bigger investors like myself and my clients. Let's say we've got 10 buy-to-let properties and you own your own property that you live in. We've gone past April the 1st, 2016 and we've just purchased a new property, although this is actually going to be another home. Now, you are going to have to pay the higher rate stamp duty. Again, if you actually sell your existing home on or before that, or within 18 months of claim, you still will not have to pay the higher stamp duty rates in this instance. Number five. Okay, let's imagine you own your own home right now and you live in it. You also own a buy-to-let investment property or maybe a second home, and that's currently worth less than £40,000. Post 1st of April 2016, you purchase another property for higher than £40,000. Will the higher stamp duty rates apply in this instance? Well, no, it won't. Because one of the existing properties is worth lower than £40,000, this won't be taken into account. So in those instances, the higher rates will not apply. Number six. Now, this high rate stamp duty will only be applying to residential property purchases. Let me give you some examples of what a non-residential property is. Commercial property, such as shops and offices. Agricultural land. Bare land, basically a piece of land which doesn't have any planning consent as such, even where the land may subsequently be used for residential purposes later. What about a mixed-use property, such as property with a shop on the ground floor and a residential flat on the first floor? And lastly, where 6 or more residential properties are bought in a single transaction. 7. Multiple dwelling relief. Now, what's multiple dwelling relief? Now, if one was to purchase, say, 6 or more residential properties in one single transaction, they would be able to choose whether to apply multiple dwelling relief to the new higher rate tax, or they could decide to use the existing rates which are bared commercially at present. I'll give you an example. Let's imagine a developer purchases 10 additional residential properties in one single transaction. Let's say this total price of acquisition is £3 million. The average purchase price is therefore £300,000. So he is purchasing 6 or more residential properties in the same transaction. So, as I said, he can choose whether multiple dwellings relief with the higher rates will apply, or whether the non-residential rates as they are currently will apply. So, multiple dwellings relief. The stamp duty due if they were to choose the higher rates applied on the average purchase price of £300,000 would be £14,000 per transaction. This is then multiplied by the number of properties in that linked transaction, i.e. 10 for this example. That would therefore give a total amount of stamp duty due of £140,000. Now, would they be better off staying under the current terms of non-residential rates, i.e. commercial? So the non-residential rates would apply in this transaction to the total value of £3 million in the same instance. As this is in the 4% band commercially, the stamp duty will be due at 4% on £3 million, i.e. £120,000. So, as the developer would have the choice, the developer would obviously choose the non-residential rates and pay £120,000 stamp duty as opposed to £140,000 under the new legislation. Now, I don't have time today to go through every single eventuality, but there is just a few examples for you. But I want to ask you one thing. Even if there were no exemptions or no ways around this higher stamp duty, would that stop you investing in property? I can tell you it wouldn't stop me. But why? What am I getting at? What I'm saying is, why would one be put off by a few £1,000s going into a long-term investment such as a buy-to-let, where you should be taking the long-term view of 10, 20, 30 years? Why would you not do that for the sake of a few £1,000s to start up? Equally, I don't buy into this rushing before the 1st of April 2016 to buy a buy-to-let property now or a second home, just so I don't have to pay the higher rates, because think of it like this. Would you rush and compete with all the other investors rushing and pay £5, £10, £15,000 more for a property because the demand's just spiked, just to save a few £1,000s? So pay an extra £10,000 to save £2. Doesn't make sense. I'd rather wait, make a sound investment where I maybe got a £10,000, £15,000 discount, and I'll happily pay an extra £4,000, £5,000, £6,000 for that privilege. Well, that's nearly enough for me right now, but thank you, and I commend you for taking the time to listen through and educate yourself, because it really will help you on your own property investment journey. As a bonus for taking this action, I've put together some market intel, which has taken quite a bit of time to collate together, but if you scroll down the page, you will see that we've collated market data which demonstrates in Poole, Bournemouth and Christchurch where all the buyers want to buy and where all the tenants want to live. Now, why would this be of any use? I'll tell you. Business and property are very similar. Property should be viewed as a business, and the simple rules of business is supply and demand. Now, if you know where all the buyers want to buy and you know where all the tenants want to live, don't you think that would actually help you choose where you should buy your next buy-to-let investment? By taking that approach, my clients and myself have capitalised by reducing void periods significantly due to high tenant demand and benefiting from higher capital appreciation because we own properties where all the buyers want to buy. So until next time, thank you for taking the time to listen to this video. I wish you all the best of luck with your own property investment journeys. In the meantime, if you have any queries, you can simply visit www.embark.co.uk/askdavid and I will be pleased to answer any questions you may have. That website address again is www.embark.co.uk/askdavid. I've been David Giles from Embark, your perfect property partner.